We've all seen massive auto giants like Ford and Chevrolet pack up and completely exit the Indian market. But right now, an even quieter, much larger exodus is happening. Welcome to This Explainer, where we're diving into one of the most fascinating contradictions in the financial world today. Foreign banks, literally some of the biggest financial institutions on the planet, are hastily packing their bags and selling off their Indian retail operations. But as we dig into the data together, something just doesn't add up. Think about it. Why are giants like Citibank and Deutsche Bank practically giving away their Indian retail businesses? Citibank, after decades of being here, sold its entire consumer banking business to Axis Bank. And Deutsche Bank? They practically handed over their retail and wealth management arm to Kotak Mahindra for a mere 300 crores. It looked like a fire sale. But then, right on the flip side, you have a bank like HSBC quietly pulling in a staggering net profit of 17,000 crore rupees in India alone. That perfectly matches the profit of Kotak Mahindra, India's third or fourth largest private bank. So what exactly is going on here? To figure out this paradox, we have to look at their actual physical presence. On paper, the data says there are 44 foreign banks with 775 branches in India. But when you peel back the layers, you realize 500 of those branches belonged to Lakshmi Vilas Bank, which was recently acquired by DBS. Take those out, and the remaining 43 global banks are operating with a mere 273 branches combined. Compare that to SBI's 23,000 branches or HDFC's 9,500. Their physical footprint is incredibly tiny.
To decode this massive banking exodus and the hidden profit strategies behind it, we're going to hit 5 key stages: the 1860s opium origins, the regulatory tax squeeze, the 40% lending trap, their pivot to corporate gold mines, and finally, the new FDI masterstroke. All right, let's start with stage 1, the 1860s opium origins.
You see, it's a huge misconception that these global banks just arrived a decade ago and are struggling to get a foothold. The real story is deeply tied to the boom of international trade. After the Second Opium War in the 1860s, the British aggressively ramped up opium production in India, specifically in Bengal and Malwa, to sell in China. We're talking massive, fast-moving international trade out of the ports of Calcutta and Bombay. With such an enormous volume of trade, there was a desperate need for finance and foreign exchange. European banks saw this massive gold rush and swooped right in to finance it.
This paints an incredible baseline. Institutions like HSBC and Standard Chartered have actually been entrenched in the Indian economy for roughly 170 years. They've literally been here since before India's independence. So why, after almost 2 centuries, are they suddenly throwing in the towel on retail banking?
That brings us to stage 2, the regulatory tax squeeze. Why did they average only 6 to 7 branches each?
Well, it boils down to how incredibly difficult it is for a foreign entity to do business in India's highly regulated banking environment. Historically, most foreign banks operate under what's called the branch model. In this setup, HSBC India isn't technically an independent Indian company. It's just a branch of its parent company in London. Because it lacks a separate legal Indian identity, it has to seek sluggish individual approvals from the RBI for every single new physical location it wants to open. It is a slow, grueling process. But the absolute crushing blow of the branch model is the financial penalty. Because they aren't registered as Indian companies, these global banks get slapped with an effective tax rate of roughly 35 to 38%. That is a massive 10 to 12% higher than the 25% tax rate paid by their domestic competitors. In the razor-thin margin world of retail banking, a 12% tax disadvantage is a total death sentence for rapid expansion. Now, you're probably thinking, okay, if the branch model is so heavily taxed and restricted, why not just register as an Indian company? It seems like a total no-brainer, right? Become a wholly owned subsidiary, get the lower tax rate, and open branches faster. But doing that drops them right into a complete regulatory minefield. Which leads us directly to stage 3, the 40% lending trap. This is where their grand retail ambitions hit a solid brick wall. The very second a foreign bank becomes a wholly owned Indian subsidiary, they are immediately hit with the RBI's Priority Sector Lending Rule, or PSL. Under this mandate, a whopping 40% of the bank's total credit legally has to be funneled into priority sectors like farmers and MSMEs. Boom! Instantly, a massive chunk of capital is yanked away from their highly profitable urban strategies. And guys, it gets even more restrictive. Notice the strict sublimits here. You can't just dump all 40% into small tech businesses and call it a day. Exactly 18% of their entire loan portfolio absolutely must go to agriculture. And within that, 10% is strictly reserved for small farmers. There is no loophole, there is no avoiding this. So here is the impossible trap. Remember, these banks have historically positioned themselves in premium, wealthy metro hubs like Mumbai, Kolkata, and Delhi. They want to sell elite wealth management in premium credit cards to rich clients. How on earth does a bank with literally zero district-level or rural branches find small farmers to lend billions of rupees to? The logistics make absolutely no sense for their business model. And if they inevitably miss this target, it's not just a slap on the wrist. They are penalized by being forced to park the missing funds into government rural infrastructure development funds, which offer absolutely terrible interest rates. So if you're wondering why you don't see their ATMs on every corner, this is exactly why. The heavily taxed branch model bleeds them dry, and the subsidiary model forces them into loans they literally can't make. Realizing that direct retail banking against Indian competitors is a losing battle, they didn't just give up. We're now at stage 4, the pivot to corporate gold mines. Instead of fighting for everyday savings accounts, they executed a brilliant pivot. They took their 170 years of global prestige and aimed it straight at high-margin, low-volume corporate sectors. Think investment banking, mergers and acquisitions, treasury services, and foreign exchange. If an Indian domestic bank advises on a massive cross-border acquisition, it might lack international clout. But when a global giant like HSBC steps in, they bring an incredibly powerful, trusted global network to the table. So the crucial takeaway here is that they aren't failing. They are simply abandoning a completely saturated space. Domestic banks have an absolute stranglehold on retail, with tens of thousands of physical branches and superior local tech integration like UPI. Hustling to sell a few thousand credit cards just can't touch the sheer profitability of advising on a multi-billion-dollar corporate merger. That is exactly how a bank with just a few branches pulls in 17,000 crores in profit. But wait, it actually gets better. Stage 5. The new FDI masterstroke. Because India recently opened up its regulatory doors, these foreign players pulled off something incredible. Instead of agonizing over opening one physical branch at a time against massive headwinds, they realized it's way smarter to just buy into the success of local players. They target strong, already existing Indian financial institutions and simply acquire massive foreign direct investment stakes directly. Look at the sheer scale of this. In a historic move, Emirates NBD out of Dubai dropped a staggering $2.75 billion to grab a 60% stake in an Indian bank. This set absolute records for FDI in the Indian banking space. They didn't bother building a retail network from scratch, they literally just bought one that was already dominating. And the buying spree is happening everywhere. Blackstone scooped up a near 10% stake in Federal Bank, and we saw a massive 39,000 crore rupee investment for a 20% stake in Shriram Finance. They completely sidestep the regulatory nightmare of the branch model and the lending traps of the subsidiary model. They just provide the capital and take a massive slice of the explosive Indian growth. So, taking a step back to look at this whole evolution, as these global giants completely trade their physical retail branches for high-margin advisory roles and massive corporate FDI stakes, are they actually leaving India? Or did they just figure out a much smarter, far more profitable way to conquer it? Let me know your thoughts on this brilliant corporate pivot down in the comments below, and as always, keep questioning those surface-level headlines.